You're watching our breaking news coverage of the Bank of Canada's latest interest rate decision. No change in rates. That continues a trend we've been watching for some time now. A sixth consecutive meeting. Officials, though, signaling they are getting closer to rate cuts, but still awaiting more evidence of slowing inflation. So the overnight rate unchanged at 5%. Here's some of what Tiff Macklem, the Bank of Canada governor, had to say. Quote, "We are seeing what we need to see, but we need to see it for longer to be confident that progress towards price stability will be sustained." Now, officials say that data since January has boosted their confidence that price pressures are gradually slowing, even as they expect economic growth to increase. At the same time, Tiff Macklem calling further declines in core inflation very recent, and adding that the bank wants to be assured this is not just a temporary dip. Against that backdrop, we want to talk to our great guests this hour. Warren Lovely, Chief Rate Strategist at National Bank Financial, is back with us, as well as Etienne Bordeleau-Labrecque, Portfolio Manager at Ninepoint Partners. Good to see you. And Diana Avigdor, Head of Trading at Barometer Capital Management. Diana, I'll start with you on the market interpretation of today's Bank of Canada news. What's been the buzz so far today?
Well, the expectations have been on balance that the Bank of Canada is not going to do anything, just like the Fed is not going to do anything. There is a feeling that they're being very cautious. Some people feel that they're being overly cautious, given that the economic data, if you measure it year over year, has come in much better. And there is some room to cut, to signal. But they obviously don't want to do that. They don't want to do that because there is growth in the economy. There is growth in stock earnings. And you know, 5%, if you look at it from a long-term perspective, it's not all that restrictive. Rates have seen generational low when the bank started raising, and 4 or 5%, it's not that prohibitive. Market is reflating, the economies are reflating, and they can sustain these level of rates. That being said, there is room for a little bit of cut. They just don't want to do it and then have it rally
Work
again.
Against them.
Yeah.
Etienne, what was your reaction?
Well, I think it's important for the bank. We all expected that they're not going to do anything today. What really we're looking for is, are they going to signal a June rate cut? With the CPI report in the U.S. this morning, I think a June rate cut there is off the table. ECB, it sounds like they're going to go. Bank of Canada this morning, not really suggesting that they're ready to pull the trigger yet, so they didn't tee it up for June. I think, and as Macklem said, the next few inflation reports are really important. In Canada, we've had positive on the downside surprises to inflation, as opposed to the U.S., where it's surprised to the upside for most of this year. So they want to make sure that they're not cutting too early. And with shelter inflation still way too high, and you look at services inflation overall in Canada, still way too high, I think that they want to make sure they don't cut too soon, and they don't want to reignite the housing market by doing like they did last year and signaling a pause, and then you reignite the spring housing market, and then you work against yourself on shelter inflation.
That was a moment for sure early last year. And Warren, I always wonder, you know, can they keep the pen at the ready if there's inflation numbers in the U.S. at 8:30 and their decisions at 9:45? But it is interesting that the Bank of Canada went through that experience of signaling something to the market and then the data working against them. Here we are watching the U.S. story, where there's been a pretty firm commitment already towards rate cuts by the American Central Bank, which seems to be working against them this morning just based on the latest inflation data. I mean, how much of that is at play here for the Bank of Canada? Just not wanting to say it because, aside from it maybe being too early, quite literally can work against you, and then that can create frustration out there.
Yeah, so there's a few things there, John. So I think, one, what the Bank of Canada is trying to do is give themselves optionality here. For June, perhaps, and I say perhaps because it's going to be contingent on this inflation relief being sustained. What they're really trying to tell you is, look, we need to be convinced that we're on a sustained and sustainable path to price stability, and they're not yet convinced. They acknowledging progress, want to give themselves the option to go to lower interest rates as early as June, perhaps July. I think, you know, in terms of cautionary tales and deja vu, I think Etienne said it well. I mean, you think back to what we went through last year. where they kind of gave the green light that they would, they weren't hiking anymore. Maybe we'd get to lower interest rates. Interest-sensitive demand reignited, and then, of course, they had to raise interest rates in June and July. They don't want to do that, obviously. So, I think they're trying to walk a fine line or, balance to some extent the progress they've had against, undue exuberance around near-term interest rate cuts.
Diana, at the same time, it's kind of interesting because, even though the economy has handled higher rates relatively well, when we compare the Canada situation to the U.S. situation, it is rare for me to find someone on the street or an economist who will say, oh, Canada's far more resilient than the U.S. economy right now. And yet here we are talking about the Bank of Canada once again hedging its bets in its language this morning.
Right. So when you look at things from a market perspective, the Canadian economy and the Canadian stock market is not the same thing. In the stock market, you have stocks that have exposure to global economy. So there are some items in the Canadian economy that don't directly translate to the stock market. So there's one thing. Multiples globally are expanding. The reflation trade means that commodities are working in the markets generally, and that benefits Canada and Europe as well, and Asia is starting to participate as well. So globally, the markets are starting to work in tandem. So the Canadian economy is a little bit behind the U.S., but if the reflation trade and commodity trade continues to work, it'll have some catch-up, as will the rest of the globe.
Etienne, are you curious to know what the Bank of Canada might say when they field some questions today about their outlook on the employment picture? Only because it was last week, I guess, we had a tale of two jobs markets, a strong print in the United States, the unemployment rate in this country now above 6%.
Yeah, so from 5% just over a year ago. So we've had a pretty large increase in the unemployment rate, and it's not only because the labor force is expanding. We've seen some net job cuts in some sectors. So the economy here is much weaker than it is in the U.S. The impact of rate hikes is finally being felt through, and the longer we keep rates here, the more this higher interest rate environment is being fed through to the economy, particularly households and the goods sector, where and the more interest-sensitive sectors. So we're seeing a much weaker economy in Canada. I think that the bank is going to look carefully at the next few employment reports. If we keep seeing the unemployment rate moving higher, it's been accelerating. They will certainly take notice, and that might lead to a more rapid pace of rate cuts because we might be entering a more precarious economic situation.
So Warren, I'm trying to do the math here. We're almost at the midpoint of April. There had been this expectation in the market that Canada might be cutting interest rates by June. So we're now kind of, I guess, sort of a 2-month period of data watching to see if there's enough of a turning point to lead to a pivot. I mean, what are you going to be watching over the next couple of months?
Yeah, well, I mean, I think in Canada and in the U.S., both central banks are telling us that they're data dependent. They're telling us as well what specific data they're watching. So in Canada's case, what are we watching? Well, it's this idea of aggregate demand versus supply. So GDP. We'll get a really important report on first quarter GDP at the end of May, ahead of the June decision. We're, of course, watching these CPI reports. We've had 2 really good ones. The U.S. has had 3 really bad ones. So if our progress continues on towards price stability, that'll help encourage them that maybe restrictive policy isn't as needed. And of course, to Etienne's point, we're going to be watching the labor market. We've seen pretty quick movement, as was argued. So if that labor market weakening continues, then the Bank of Canada is going to have confidence that wage growth will be a little calmer, and that'll also give them perhaps what they need to justify a move to lower interest rates.
We do have the Canadian CPI numbers, the sort of comparable data to what we got in the U.S. today. Next week, right now, looks like the street's looking for around 2.9%. So, whether that's really enough progress to signal anything to the market, I'm not sure. Diana, I do want to just remind our audience, it's been an interesting morning in the currency market. We'll take a look at what's been happening with the Canadian dollar against the greenback. And just a reminder that because you had that hotter than expected inflation number in the the United States today, all of a sudden that led to some weakness in the Canadian dollar. It signals that the U.S. keeps rates higher for longer, so that leads to strengthening for the American currency and weakening for the Canadian currency. I wonder, though, how much we have to think about what a weaker loonie means for our economy as well. I mean, let's face it, the resilient American economy and our ability to export there has been a helping hand for the Canadian economy, too.
For sure, and that's going to continue. And, you know, I had a thought when Warren was talking about good numbers, bad numbers. I'm confused what I want, right? Do we want labor market to weaken so that we can have a 25 beep cut? Or do we want to keep the economy strong, which means you have some pricing pressures, you keep rates where they are. It's a little treacherous to navigate what's good data and what's bad data.
And no, it's a great point. And, you know, Warren, I think the other thing is you keep hearing about how tight our housing market is. We simultaneously have seen record population growth to grow our economy over the long term. But that arguably creates a complicating factor on rate policy after a rapid escalation in rates and home prices coming off their peak, but not coming down as much as some had thought. And now you have this dialogue every day. Everyone's saying, when are they going to cut rates? When are they going to cut rates? I'm ready to get back into the housing market. I would imagine the Bank of Canada has to be mindful of that, because that becomes an inflationary concern for them, too.
Yeah, absolutely. We're going through really an unprecedented experiment here on our demographic policy, on immigration, on population growth. Has so many tentacles, including, of course, in housing markets, on rents, on housing prices. You're hearing the Bank of Canada acknowledge the distortions the population growth of this magnitude creates in terms of assessing where the economy really is. And I think you're also hearing them acknowledge pretty clearly that that's creating shelter pressure that probably they can't control as much as they would like. So a lot of complications there to try and manage through, and that's really what happens when you go into an unprecedented stage in terms of population gains.
Etienne, how are you thinking about the housing?
Well, you know, when I was at the Bank of Canada, I worked under Governor Carney, and he always said the policy rate is a very blunt tool to manage the economy. And as Warren was saying, the housing sector is really what's driving a lot of services inflation right now. And using monetary policy alone to dampen housing demand can be quite damaging in the long run. So it's helpful that we're seeing some other measures being taken by different levels of government to try to remove some of that pressure, but it'll take time. You know, there's only so many homes we can build in this country for any given year. So I think it would be a mistake for the bank to start cutting too soon and start reigniting this housing market. There's going to be some help on the way in terms of demand probably next year as some of these immigration numbers come down and some of these temporary students and foreign workers come down. But we need time. This economy needs time to absorb the increase in demand we've seen across the board, not just housing, but other services demand. And that's why I think they should err on the side of caution and wait as long as possible to start cutting rates. In my mind, this should be a September decision, not a June decision.
A September decision, which then obviously is, there's so much going on this year. You've got we get a number of election cycles around the world, but you got one in the U.S., so that's already got people there talking about at what point the Fed has to hit the brakes on even talking about rate moves. And even in this country, I mean, we're on the doorstep of a federal budget. We've seen the federal Liberal government crisscrossing the country, talking about new spending in all sorts of areas recently. Warren, can we have this conversation on rates, to Etienne's point about the blunt tool that is monetary policy, without talking about the levels of government spending? Certainly the markets have been paying attention to the government spending around the world.
Yeah, you can't divorce these two policy tools. You really need to think about, what is the appropriate monetary policy stance, interest rate policy, given what governments are committing to. And I think what's pretty clear coming out of the provincial budget season and with the federal budget, just now days away, is that governments are continuing to contribute positively to the economy, or I guess you could say spend. right? So there's a fiscal impulse in this country that maybe is complicating life for central banks. I think it's probably true in the United States as well, where you've got a really unsustainable fiscal path that's creating activity in the U.S. that wouldn't otherwise be there and leading to higher interest rates than you would otherwise need.
Yeah, they're rowing in different directions, really. You know, if you think about fiscal, it's rowing in expansionary, and then monetary policy is trying to slow things down. So the two levels of policy are kind of working against each other, and that's not helpful. And that's not been helpful for this whole inflationary experience. Some people might even argue has been at the source of some of this inflationary experience we've had over the last 2 years. And so we'd like to see governments pare back spending, at least contribute, at least stop contributing positively to the economy, at least be flat, balance their budgets, and with these higher rates, feeding through their own budgets as well, not just households.
And Diana, this gets back to what is it we want? Like every day I'm trying to make sense of the moves in different asset classes, and gold, which had this record run up. You know, a lot of people would traditionally look at that as an inflation hedge. It was down today because we got an indication that rate cuts are not coming soon enough. So that's an interesting development. But also you talked about the stock market being on its own path that isn't quite parallel to the economy itself. Coming into today, we had the Canadian stock market at a record high. So what do people have to know about those driving forces of the equity market in 2024?
Well, you want to be invested in companies that have pricing power. You want to be invested in companies that have strong balance sheets and don't need to raise capital at rates that I also think that rates stay higher for longer. There may be a period that there's going to be small cuts. As you know, in the U.S., the market's priced in 6 cuts, and now we're at like 2.5, and has done quite well through this move back from more cuts. So the market's not really trading on rate cuts. The market wants to trade on earnings growth and economic growth, and is willing to pay the price on the inflation part if that doesn't come down, because it has come down a lot since a year ago. So on the lockstep basis, day to day, maybe we're down today because of the strong CPI number in the U.S., but what the market wants to see is growth and earnings. And, earnings for the first quarter, or the last quarter, which is starting this week and in Canada in a week or two, earnings growth is about 10%. Earning growth of 10% is fine. Be careful what you wish for. I hear you on the fiscal spend, but the fiscal spend has offset the monetary tightening almost to zero. And in the U.S., I can't see anybody shaking the tree. It's an election year. So for now, from a stock perspective, you want to be invested.
Just worth noting that when the U.S. President Joe Biden was asked about the inflation numbers today, he was calling on companies to use their record profits to lower prices. So there's always the political component for those companies as well. But just before we take a quick break, Warren, I mean, a lot of people thought we would be in a different economic situation today. If you go back a year and a half, 2 years ago, even a year ago, that things were deteriorating so quickly that we had to start having this conversation around interest rate cuts. So just building on what Diana is saying, maybe we should be a little bit more happy that we've got the kind of economic picture that we've got right now, even though it's been pretty challenging for people in navigating inflation and higher interest rates? Yeah,
there's nothing wrong with economic resilience, right? And we've had that in the U.S. more so than in Canada. What you want, though, is that economic resilience to intersect with at least a chance at price stability, a bit more controlled inflation. That's kind of what we're getting in Canada here more recently. The U.S., this reacceleration in inflation, I think, is something that we'll need to watch very, very carefully, because that could short circuit, the pathway to lower interest rates there.
All right.